Picture this. It's March 15th, 2008. Bear Stearns collapses over a single weekend. What looked like a contained liquidity problem suddenly reveals itself as systemic fragility. Phones are ringing non-stop across Wall Street. Prime brokers are scrambling. Hedge fund managers are staring at screens that don't make sense anymore. Credit markets are freezing. Party trust is evaporating. And inside the most powerful financial institutions on the planet, senior partners are not debating strategy. They're asking a much more basic question. Are we going to survive this? Now imagine one investor sitting at his desk in the middle of that chaos. Calm. Not confused. Not shocked. Not scrambling. Because he had already positioned for it. He wasn't reacting to the crisis. He was executing a plan written months earlier. That investor was Stanley Druckenmiller. And when the dust settled, while many funds were destroyed, he preserved capital and then deployed aggressively into the recovery. Why start here? Because today, early 2026, Druckenmiller's positioning suggests he sees structural similarities forming again. Not identical to 2008. History never repeats perfectly, but structurally similar in one critical way. Surface-level stress building beneath the setup may be even more complicated. Before we dive into the 3 warning signs he's focused on, there's one foundational fracture you need to understand. Right now, 2 lines in the U.S. economy have violently diverged. The first line measures consumer confidence in the stock market. That number is near multi-decade highs, higher than levels seen in parts of the late 1990s, higher than most periods that preceded major downturns. The second line measures consumer confidence in personal financial well-being. That number is near levels seen during crisis environments. Pause for a second. People feel great about asset prices, but anxious about their own lives. Excited about stocks, but worried about rent, healthcare, groceries, long-term savings. That disconnect is not a statistical anomaly. It's structural tension. Druckenmiller has studied every major financial reset of the last 100 years. The pattern is not obvious collapse. It's divergence. Azure asset inflation is divergence. Since Druckenmiller has studied every major financial reset of the last 100 years, the pattern is not obvious collapse. So what step inside its instead major financial reset is the last 100 years. The proprium is not obvious collapse. The materim studied is not obvious collapse. Druckenmiller has studied every major financial reset of the last 100 years. The pattern is not obvious collapse. The second line has studied every major financial reset of the last 100 years. The pattern is not obvious collapse. Since Druckenmiller has studied every major financial reset is the last 100 years, the pattern is not obvious collapse. Pause for a second. People feel great about asset prices. It's structural tension. Druckenmiller has studied every major financial reset is the last 100 years. The pattern is not obvious collapse. The second line has studied every major financial reset is the last 100 years. The pattern is not obvious collapse. Druckenmiller has studied every major financial reset is the last 100 years. The pattern is not obvious collapse. In this place, they're going to the justice in venturing asset inflation, they justice to the place of asset prices. Truth,
The main matter women and seen inventory, the additional takes prices and to live. They were stilled in the truth. They started friends angled proceed and destroyals and similar changes ways, and head and the similar from them to one steady judgment. They were moved in it and the bottom from changes ways and the truth of clums. The main matter women and seen inventory, the additional takes prices and destroyals and head and the similar from them to one steady judgment. They were moved in it and the bottom from changes ways and the truth of clums. The main matter women and seen inventory, the additional takes prices and destroyals and head and the similar from them to one steady judgment. They were moved in it and the bottom from changes ways and the truth of clums. The main matter women and seen inventory, the additional takes prices and destroyals and head and the similar from them to one steady judgment. Should you have no rescue and for meal levels prices and destroyed. The words will complete in easy eventuary before you get all of it that the proprium was more present prices and destroyed. The words will complete in easy eventuary before you get all of it that the proprium was more present prices and destroyed. Downturns of economic reality. Since 2010, real personal income in the United States, adjusted for inflation, has grown roughly 50%. In the same period, inflation-adjusted returns in the S&P 500 have approached 300%. 50 versus 300. That is not a gap. That is a canyon.
And historically, canyons between asset prices and income growth do not close gradually. They close through repricing. That is the macro backdrop. Now let's move into the three signals. Signal 1. The debt spiral. The U.S. federal debt now exceeds $30 trillion. But headline debt isn't the real issue. The real issue is the compounding interest burden. The United States now pays over $1 trillion annually just in interest. That exceeds military spending. It exceeds many core discretionary budget categories. And critically, it does not reduce the principal. It is pure servicing cost. Now consider how we got here. Over the past 15 years, enormous volumes of debt were issued at near zero interest rates. As those bonds mature, they must be refinanced at today's rates, 4%, 5%, sometimes higher. When rates rise, the interest burden doesn't adjust slowly. It jumps. Higher rates, higher interest payments, larger deficits, more borrowing, even higher interest payments. There is no internal mechanism that reverses this loop naturally. It is a mathematical spiral, and mathematics does not negotiate. Eventually, either spending is cut dramatically, taxes are raised significantly, inflation is allowed to erode the real value of debt, or growth accelerates enough to offset it. Each option carries consequences. None are painless. And here is the uncomfortable truth. Markets have not fully priced in what a structurally high interest burden means for long-term fiscal flexibility. Signal 2. The liquidity drain. Most investors watch price. Druckenmiller watches liquidity. Liquidity is the oxygen of financial markets. When liquidity expands, risk assets rise. When liquidity contracts, fragility surfaces. Right now, two forces are operating simultaneously. The U.S. Treasury must borrow roughly $2 trillion this year to fund deficits. At the same time, the Federal Reserve continues quantitative tightening, reducing its balance sheet by roughly $60 billion per month. That's over $700 billion per year of liquidity withdrawal. Combine those forces, you're looking at nearly $2.7 trillion of liquidity pressure in 1 year. To contextualize that is nearly the size of the largest company in the world being removed from systemic liquidity annually. Liquidity drains in stages. It doesn't crash immediately. First, small caps underperform. Then regional banks struggle. Then commercial real estate valuations weaken. Then credit spreads widen quietly. Then correlations rise. And finally, when liquidity becomes scarce enough, repricing accelerates. We may be in the early to middle phase of that drain, and most investors are not watching the plumbing. They're watching the index level. Signal 3. The credibility trap. For 4 decades, there was always an emergency lever. The Federal Reserve. 1987, rate cuts. 2000, rate cuts. 2008, zero rates and trillions in QE. 2020, massive liquidity injection. Each crisis ended the same way: central bank intervention. But today, inflation remains structurally elevated compared to pre-2020 norms. If the Fed cuts aggressively, inflation risks re-accelerating. If they don't cut, debt servicing pressure intensifies. This is the trap. The traditional emergency lever may no longer function without causing collateral damage. Markets still implicitly assume that if volatility spikes, the Fed will step in. But what if stepping in creates a second crisis? That's the credibility constraint. And markets have not yet fully tested that scenario. The asymmetry of positioning. Critics argue Druckenmiller has warned early before. He has. But he makes a key distinction. Being early is not the same as being wrong. If you remain defensive and markets rise 10%, you miss incremental upside. If you remain fully exposed during a 40% drawdown, you lose years of compounding. The asymmetry is enormous. Risk management during structural transition is not about predicting the exact date. It's about protecting capital from irreversible damage. Current positioning logic. Based on public disclosures and interviews, his framework leans toward significant cash and short-duration instruments, optionality, selective short exposure in structurally fragile sectors, debt-heavy, liquidity-dependent models, gold exposure, a hedge against institutional credibility erosion, energy exposure, because monetary expansion cannot create barrels of oil, defensive consumer businesses, stable demand, pricing power. Notice what's not dominant. Over-concentrated high-beta tech exposure, speculative retail narratives, momentum-driven positioning. This is not a momentum portfolio. It is a resilience portfolio. The psychological edge. Druckenmiller repeatedly emphasizes something most investors underestimate: psychology. The greatest losses during resets do not come from lack of information. They come from emotional rigidity, the inability to adapt, the attachment to narratives, the refusal to reduce exposure when evidence shifts. Markets punish ego. They reward flexibility. When facts change, positioning must change, immediately, without attachment. The pattern of resets. Major resets rarely begin with headlines screaming crisis. They begin quietly. A regional lender posts unexpected losses. A bond auction underperforms. A large corporation fails to refinance at expected terms. Analysts call it isolated, then another, then another. Liquidity tightens further, confidence shifts. And suddenly, the repricing accelerates. By the time the majority recognizes systemic risk, the window to prepare is closed. The structural overlay now layer in. Record federal debt burdens. Structural fiscal deficits. Elevated geopolitical tension. Supply chain fragility. Energy choke points. AI-driven capital concentration. This is not a single variable environment. It's multi-variable fragility. Each variable alone is manageable. Together they amplify each other. Debt increases sensitivity to rates. Rates constrain central banks. Liquidity withdrawal stresses weak balance sheets. Geopolitical tension pressures energy. Energy pressures inflation. Inflation pressures central banks. And the loop tightens. The bigger question: is a reset guaranteed? No. Markets are adaptive systems. Innovation continues. Productivity gains from AI may offset some fragility. But the probability distribution has shifted. And Druckenmiller isn't making emotional forecasts. He's recognizing pattern alignment. Debt stress. Liquidity contraction. Policy constraint. Asset-income divergence. When these align historically, volatility is not minor. It's structural. The final insight. The next reset, if it unfolds, will not reward the most optimistic investors. It will not reward the most aggressive. It will reward liquidity, flexibility, optionality, prepared capital. Because when forced selling begins, those with cash dictate terms. Those without it accept them. The opportunity of a lifetime often follows the reset of a lifetime, but only for those positioned before panic. The window to prepare does not remain open indefinitely, and once repricing accelerates, positioning becomes reactive. Arithmetic does not care about sentiment. Liquidity does not negotiate. And structural imbalances do not resolve through hope. They resolve through adjustment. The only question is whether that adjustment is gradual or abrupt. And that is where we are right now, watching the alignment, watching the liquidity, watching the debt, watching the credibility constraint. Because when systems stretch far enough, they eventually snap. And the difference between survival and compounding is rarely brilliance. It is preparation. See you in the next one.